Hi folks, David Waring here again with InformedTrades.com and our second lesson in a three-part series on the subprime financial crisis. In yesterday's lesson we took a look at the borrower side of the equation and a little bit of the history there. In today's lesson we're going to take a look at the lender side of the equation and a little bit into how the bank side of and the financial institution side of the equation is structured. In order to understand how this problem got spread to so many different areas of the economy and so many different financial institutions, both here in the United States and around the world, we must first understand a process which is known as securitization. And basically what securitization is taking a asset which was previously untradeable or unstandardized and standardizing that asset into a tradable instrument, okay? And what this securitization applies to a lot of different things, but for the purposes of this lesson we're going to just look at how it applies to mortgages. When you used to go to a bank to get a mortgage, what would happen is the bank would lend you the money that they had on deposit, so the depositor's money, and they would hold that loan, earning the fees that they charge you for borrowing that loan, plus the interest rate that they charge you over the term of the loan. And because they were holding the loan, they also held the risk if you didn't, pay that loan back. So to apply this securitization process to the banking industry fairly recently, what the investment bankers did was come up with a way of pooling a bunch of these mortgages together that a bank had and then standardizing those pools so they could then be sold off and traded among a bunch of different financial institutions. And what this did was free up a bunch of capital for the bank so that they could lend out more money, all right? Because before they were restricted to they could only lend out or do as many loans as they had money on deposit, where now with the securitization process they could continue to do loans and just continue to sell them off if they just wanted to earn the upfront fees that they charged for doing those loans. So this is also a good way to diversify risk for the bank if they wanted to do that. All right. So the pools that, just for your knowledge, because you probably read about this in the paper and stuff, the pools that these mortgages are put into are referred to as one of three things normally: either a asset-backed security, a mortgage-backed security, or a collateralized debt obligation. And you also may see MBS for mortgage-backed security, ABS for asset-backed security, or CDO for collateralized debt obligation. So you don't really need to understand all the details there, but what you do need to understand about these pools of mortgages is a couple things. A lot of the financial institutions that are potential buyers of these things are restricted from buying subprime debt, okay? In order to get around that, well, they're restricted. Firstly, just know that they're restricted from buying this subprime debt because obviously it's more risky. But in order to get around that, what investment bankers did was take the pools of mortgages that contain subprime debt and then divided those pools up into different levels depending on who was the first to take the losses if some of these mortgage holders stopped paying their mortgage payment. Okay, so let's say you take one of these big mortgage-backed securities with $50 million worth of mortgages in it and then divide it up into 5 levels. The first level down, so the lowest level, would be the first to take any losses from people stop paying their mortgage, and the highest level up, the 5th level, would be the last section to take any of the losses. And those levels are also referred to as tranches if you read anything about that. And so what this allowed these investment bankers to do was then have the credit agencies come in that are in charge of rating this debt and give high credit ratings to the higher levels that were going to be the last to take the losses, okay? It gave them a way to at least sell off some of that subprime debt to some of these financial institutions that previously would not have been able to hold the subprime debt in its current form, all right? The next thing that it's important to understand is that for a lot of these banks and institutions that own a lot of this debt, they did so in what's called a structured investment vehicle, or SIV for short, okay? And basically what this is one big pool of pools, so to speak. So a mortgage-backed security, or one of those mortgage-backed security pool of mortgages, might hold $50 million worth of mortgages. One of these structured investment vehicles would hold, a bunch of these mortgage-backed securities, maybe $1 billion worth of them. Okay, so basically what these things are, these structured investment vehicles, which you're probably reading a lot about as well, are off-balance sheet entities that are set up almost as separate from the core company from a regulatory standpoint and from a financing standpoint, which gives them a lot more flexibility with what they could do. Okay, and there's a lot of criticism about that and a lot of debate going on about that, which you're going to hear probably a lot about because, you know, a lot of people say the only reason they set these things up was so they could avoid regulatory oversight. But anyway, the important thing the thing that's important to understand about these is that how these things operate is they issue short-term debt, okay, to buy these longer-term mortgage-backed securities, okay, and because most of these companies that are doing this, like Citigroup is a big one that's gotten into some problems recently. You probably read about that. Because they're normally considered very creditworthy, they can issue that short-term debt, and also because it's short-term, they can issue it at a very low interest rate, and then they're earning a higher interest rate on the mortgage-backed securities or these big pools that they're buying, and so they're earning the difference in interest rate there, and they're profiting that way. Okay, because they're off balance sheet, they may also use leverage that they wouldn't be permitted to do if they're on balance sheet, you know, etc. So, but just the one thing, if you don't understand all the, you know, everything that I've set up to that point, just make sure you understand the way they fund these things is by issuing short-term debt at a low interest rate and buying this longer-term debt and earning a higher interest rate on that. Okay. And all this went, you know, well from both the borrowers and the lender's standpoint until interest rates started to rise and some cracks started to appear in the subprime market. All right, and we're going to start there with tomorrow's lesson, and we're going to kind of bring everything together that we've learned yesterday and today, and hopefully by that point you have a good picture of exactly how we got to the place where we are now, and hopefully you'll understand the situation a lot better. So we hope to see you in tomorrow's lesson. As always, if you have any questions or comments, please feel free to leave them in the comments section below. And have a great day.